Welcome back, or welcome for the first time to our Ardenwood Presents 6-month webinar series called The Timeless Impact of Planned Blessings, Legacy Planning for short. I'm John Mitchell, and I serve as Executive Director and CEO of Ardenwood here in San Francisco. Thank you for joining us today. Why are we focusing on legacy planning? Because without good estate planning, a considerable portion of our estate will go to the government instead of to our loved ones and the causes and charities of our choice. Good estate planning is intentional, intelligent, effective, and loving. I'm sometimes told at the dinner table that I repeat myself at times. Well, in this case, I'll gladly take it on the chin because I want to make a helpful or share a helpful acrostic I made up for the simple word plan. It's prayerful listening, acting now. And it's the acting now part of the word we are emphasizing through this webinar series. Too many families discover that if you don't have a plan for yourself, it can cause untold distress among family members, or that the state can claim a sizable portion of your estate through taxation. A good estate plan will enable your legacy to go on to your family, to the charitable organizations and causes you care about, instead of to the government. And Ardenwood is one of those charitable nonprofit organizations. Donors like you are invaluable to our work here. They make a tremendous difference to our budget and our work. And in return, we strive to provide you with the best possible care, as well as informative and inspiring events like this one. You enable us to be our best, and we thank you. We hope today's webinar and those to follow in October, November, and December, along with Q&A opportunities, answer many of your questions and generate more. We are always happy to answer them. Finally, the content shared today is only informational and is not intended to be legal advice. A replay of this presentation will be available on our website tomorrow morning. And now, let me introduce or reintroduce Jim Maher and Rick Bailey. Jim is a certified senior advisor and a broker consultant specializing in Medicare. He's been helping individuals and companies navigate Medicare since 1989. Jim is also a certified long-term care insurance strategist. Jim and his wife of 35 years, Teddy, live in Lincoln, California, just north of Sacramento. Jim has talked to well over 1,000 Christian Scientists since our first webinar together last October, answering innumerable questions about Medicare, long-term care insurance, and estate planning. He's been a tremendous blessing to our field. And from what he's told me, he has loved meeting and working with all of you. Rick Bailey is the founder and chairman of CAMUS, one of the most highly renowned estate planners in the United States. As a certified financial planner, or CFP, with a master's degree in accountancy and taxation, as well as a Juris Doctorate, or JD, which means he's an attorney, Rick Bailey is a highly valuable asset to private clients, CPAs, attorneys, financial advisors, and life insurance professionals for his expertise in advanced estate planning and case design. Now, before we begin, let me explain how you can ask questions today. If you look at the bottom of your Zoom screen, you'll see an icon that says Q&A. Please click on it and a screen will appear where you can type in a question. Press submit and it will arrive here. We'll collect them and save them for the end of the presentation today and/or for Thursday's Q&A. We are the only ones that see your questions. Please join me now in welcoming Jim Maher and Rick Bailey.
We're happy to be here and to be part of this again. And in this presentation, we're going to be able to go through and talk about a lot of the alternatives that we have for long-term care. And especially as we look at long-term care, it's really not a one-size-fits-all. it really needs to be planned for, and we want to make sure that everybody gets to really have the plan that fits them. So as we go through, you'll see that we're going to hit a lot of different things. Some of it repeats from prior, but it really is one that we're looking at how we can best fit a plan for you. There's a lot of alternatives to long-term care, and Jim and I spend a lot of time looking for other alternatives as we age, as we have health issues, as we look at how we can pay for these long-term care policies. There's a lot of different options that we want to look at, and we'll go through a bunch of those today. As you also look at it, when we're planning, we always have multiple goals. And those goals can be, different issues with family. We're always looking at income and assets. A lot of times when we're talking long-term care, we're also talking about retirement years. So if we're looking at retirement years, it's the income for you, it's the income for your spouse, possibly for kids and grandkids. All of these competing goals can pull some of that money every which direction. What we want to make sure is that as we look at those goals, that we're finding a long-term care strategy that fits for you. So that as we look at how that can fit for you, we make sure that we're hitting the right targets. So of course, everybody wants to know is does this apply to me? We don't know. We know statistically that the majority of us will need long-term care. And so it's one, we want to make sure it fits into what you want for your planning. Of course, we always get this, is it too late? Has my time frame passed of when I can put this in place? And this is one, and I've heard Jim say this a lot. When's the best time to plan? Yesterday. When's the next best time to plan today? And what's the worst time to plan tomorrow? If you really think about how true that is, if we could go back in time and erase all the mistakes that we make, and we just make new ones, but there again, we start with where we're at today and figure out what's the best options for going forward. If you look at long-term care planning, and the reason we include this as part of the legacy plan is we're always looking at what we need to protect. And what I like is when we get into the long-term care planning, we're protecting the biggest asset, the most important asset for you, and it's you and your family. We want to make sure that you're taken care of. And if you really look at long-term care, I think it's going back to this definition. What is long-term care? It's not a place or a condition. It's going to be a life-changing event. I'm seeing this going through right now with an uncle, that the whole family is now at a time where dementia is set in, and how do they take care of it? But it really comes into making sure that you have your plan. But if you're going to have a long-term care event, it's really, if you think about this, if you ever need care for a period of time in your life is not going to end. But the reason we're protecting the family is someone else's lifestyle is going to end. Somebody's going to have to provide care. And Jim, you've dealt with this probably more than I have.
Yeah, this is my 33rd year of helping people with long-term care situations. And we're dealing with my mother-in-law right now. I think I mentioned that last time, who my wife and my sister-in-law are the caregivers. And myself and my brother-in-law are kind of the secondary, right? We're go over, if you mow the lawn, pull weeds, help her do things, redo the shower for her, things like that. But it doesn't impact hers as much as it impacts my wife and my sister-in-law. I mean, they both work 40 plus hours. They have lives. And it's hard because they love their mom and they want to make sure that they're doing, taking care of her, Rick. But it's really hard because my mother-in-law had the means to do it. Quite honestly, she got a long-term care policy years ago and she let it go. her advisor said, well, you probably never need that and we should use the money elsewhere. Well, not only did the money run out, but now she has no long-term care. So she got some really bad advice. And like you said, it's not about her now, it's about my wife and everybody else's life that changes to kind of take care of someone you love. And it's just unfortunate, but it does happen. People just, they just fail to plan sometimes, Rick.
And just here's a quick question for you. Is it bringing the family closer together?
Yeah, absolutely not. You know, and from doing this from so many years, it doesn't matter. I've seen 2 adult children, 3 adult children. Just to stay on my mother-in-law, my wife and her sister provide all the care, and the 3rd sibling, who's not anywhere around, he doesn't do much, but he sure likes to, you know, put his opinion in on what should be done. So some people are more concerned about what's going to be left for them, as my wife and my sister-in-law are so diligently taking care of my mother-in-law. So again, Rick, you're right. It's about how it changes and it impacts a family, and it kind of pulls them apart, right? Siblings that they worried about maybe more than just taking care of their mom, maybe the assets, things like that. So yeah, it definitely pulls the family apart.
And I think that leads in real good to this next slide, because I think this is the one that when we personally start thinking about long-term care and how it's going to affect us, think about this, ask yourself these questions. If and when you need care, where do you want to receive the care? Do you want to have input into that now? Or is it let the family see what happens? Then let's look at who will provide your care. And I think Jim's example is perfect, because if you don't plan ahead, the burden falls to the family. And is that the most appropriate place for the care to happen? And I think we all have dealt with that at some level. And we just need to make sure that we're looking at, do we want the family providing the care? Or do we want the family managing the care and being there to be personally involved with your loved one?
Right.
And finally, who will pay for the care?
Yeah.
And I, you know, going back to Jim's example, I've got a friend that's, you know, just went through the same thing, that, you know, some of the family members were stepping up and helping. Others complained about the cost. And it was just one that it wasn't there was no plan. They didn't think through how and what would happen and how that can happen. So if you start looking at long-term care planning and looking at the options, I think the default is self-pay. When the time comes, it's crisis planning.
Right.
The accident has happened. Now what? And so we have to start interrupting income. We have to start, selling off assets. And the problem we create is every time you reach into that income and assets, you're taking away potentially from the rest of your plan. Nobody, it's one, if you've got a spouse at home, what happened to his or her lifestyle? Because you're taking the income that you were planning for retirement and now using it for long-term care.
That's right.
Or, and I think I've used this example before, talking to my dad. He was going to use an annuity for his long-term care, but I know my dad. My dad is a retired CPA, farmer, will do anything not to pay taxes. And he would never use that annuity in his life if he has a choice to pay long-term care, because it would have cost him taxes. And we'll talk about how we can overcome that. The other one that is a default is Medi-Cal and Medicaid planning. When you look at Medi-Cal and Medicaid, it's really designed for those that just don't have the ability to pay for themselves.
Right.
And it's one where you don't get to pick where you're getting care. You don't get to pick what happens when you're care. You're told what your care level is and what they're going to pay for. So there again, it's not as much planning as it is crisis. finally, what we want to talk about is how can we use insurance as part of the plan and really transfer that risk to an insurance company. And what I like, and there again, back to what Jim and I work on a lot, is finding options. How can we use these plans that the insurance companies come up with? How can we use those best for your planning?
Right.
And there's
And
a
Rick,
lot of options.
right. And what's important too, because you are Christian Scientists, and every day we're looking for other insurance companies that are Christian Science friendly, but have the type of policies that we can use that would allow you to, for example, stay at Ardenwood if the need be, or Chestnut Hill, or whatever the situation is. But we're constantly looking for you. And with Rick's help, I mean, we went from a couple companies now, I think 2 or 3 that I had, to about 4 or 5. So it's very helpful. Rick's really a life insurance expert and understands it. And we want to use that leverage for long-term care. So we've got some great examples in there, but I want you to know that we're always looking for ways to help Christian Scientists, especially with long-term care planning.
Now, as we look at this, now it's when we start talking of long-term care and shifting that risk to the life insurance companies or the annuity companies, the big thing that we always have to remember, there's a qualification process. And this qualification process, they're looking at age, they're looking at, male or female, they're looking at how big of a benefit you want. All of this comes into how you qualify and what you qualify for. And so as we look at your goals, this is Jim's questionnaire. And as you see from this, Jim asks a lot of questions about you, what type of care you want, what assets you have available, what your income is. All of this is coming in so we can find out more about you and create the options that are available for you. And so it really is all of these aren't cookie cutter plans, but the more we know about you, the better we can create the options for you. So it's really is a process. And as we're looking at this, we're always going to look at what are the potential assets that we can use. If you look at all of these assets, whether it's your income, your savings, could be an old life insurance policy, could be a current annuity. As we look at all of these different assets, what we're looking at is, can we use them better? So as you start looking at your planning, it's always one where you've got your plan, you've built this plan over your lifetime. And a lot of times we talk about retirement. And I see a lot of the financial literature is how to build for retirement, how to get to retirement. They don't tell you how to use the assets and income in retirement. And one of the things that we come across is IRAs. Well, people build up these large IRAs. Now they don't want to use it because they have to pay tax to use it. So we'll work through those issues and help you figure out what's a better way to leverage your money, but also how to use your money the most appropriate way possible. And also when we look at how to pay, it's how often to pay. So if you start looking at this, we're going to look at ways that, do we pay it all at one time? Do we spread the premiums out over 10 or 20 years over to age 65 or for your whole lifetime? All of these options are available. And there again, there's one's not better than the other. It's what fits you. So it's always one where, we want to make sure that we're figuring out where we're at today and where we want to go and create that roadmap to create the best plan possible. But at the end of the day, what we're always looking for, can we leverage what you have now? Can we create something better? So if you think about this, if we're paying for care, it's like when we go buy a car. We don't go to the car lot and say, what's the most expensive car? That's what I want to buy today. we always go and find the car that we want, and then we negotiate to get the lowest price possible. The same thing happens in long-term care planning. We want to go out and get the plan that fits best for you, and then see, can we get the cost down? Can we get it for the lowest price possible? So if we can turn $1 into $3, $4, or $5, that's leverage. That's creating more from what you have now. And so we use these different, policies for leverage. And so as you look at this, we're going to talk about asset-based long-term care and how that all works. But what I want you to understand is we're looking at asset-based care or insurance with long-term care riders. We're using these as the tool to create that leverage, to be able to take care of you when those long-term care events arise. So that's why we base it off of these types of policies. Now, the reason we like using these asset-based care policies, number one is they're not use it or lose it. A lot of the traditional long-term care, think about your car insurance. Your car insurance, you go pay pay premiums for the last 20 years and never got into an accident. Does the insurance company ever call up and say, here's your money back since you didn't get into an accident? Has that happened to you yet, Jim?
No, they usually cancel you or want more money. No, I wish we could have asset-based homeowners insurance or car insurance, Rick, for sure. So
yeah. And so what it is, the life insurance companies, the annuity companies are looking for ways to help you use the money that you've put in there. Right. So what's nice about this is we've got guarantees. And so anytime that we're looking at long-term care, we want to look at the guarantees. And a lot of, and it's kind of a tough time in the long-term care space right now, because companies like Genworth had a lot of promises made out there. They just weren't guaranteed promises.
Right.
And now people are getting bills that are either terminating their coverage, increasing the cost, or decreasing the benefit.
That's right.
And I think, Jim, you're doing that with CalPERS is in the same way.
Right, yeah. CalPERS was the largest issuer of long-term care policies in the nation. They've issued more long-term care than almost any other company combined. But the problem was they weren't, they're not an insurance company, so they kind of do what they want to do. So I think they've had 10 to 12 rate increases over the years. They just had a large settlement. So now they're going to all their policyholders and saying, listen, we will give you X amount back on your policy if you turn your policy in. So that's just an absolute disaster right now here in California. I've talked to many Christian Scientists actually that have those policies, and we're trying to figure out an alternative plan for them. So that's not helping the long-term care industry. So bottom line, those use it or lose it type policies are dinosaurs. They're gone. It reminds me of, remember those big cell phones, the big box ones? That's kind of what those policies were. They served a purpose, and I know they've helped a lot of people. But when we talk about the new asset-based plans, which I've helped a lot of scientists with already, they're awesome. It's a way to really take care of your family. And like Rick said, the next slide's really, we're just going to roll right into that, Rick, I think, on how the asset-based plan works. I love this this slide. I try to, create something that makes it simple for people to understand, right? So I'm a big cartoon guy. I think people like to be educated and still have fun. So like Rick said, if I'm taking in this case, $100, and I'm giving it to the insurance company, I say deposit, but you have to be healthy enough to get it, quite honestly. So you have to be healthy enough to put the money with the insurance company. In turn, the insurance company says, listen, we can turn that into 3 to 4 times. It's a multiplier for tax-free long-term care benefits, right? Too good to be true? Well, not really, because it's in a life insurance chassis. Over time, if we do an inflation option there, both the coverage grows and your dollars also grow inside the policy, right? So far, so good. You're going to see here, if you want to cancel, which most people don't, but you know what? You kind of like to know that, like with Nationwide Plan, after 5 years in California, if for example, you had that policy and you said, you know what, that's not serving my needs anymore. I don't really want that. I want to cash in. In California, in the 6th year with nationwide policy, you get all your money back. Think about that. I mean, how many insurance companies are going to say, I'll insure you for 5 years, and if you decide you don't want it any longer, we'll give you your money back. So if you want to walk away and cancel it, you can. Not recommended, but I've seen some people, I think it makes you feel good knowing that, right, my money's there, and if it's available, if I want to get to it. And finally, if you pass away, right, and don't use the benefit, unlike all your money goes away with the traditional plans, guess what? Your beneficiaries get a tax-free death benefit back. And I've been asked several times, well, what if I use some of the benefit? Well, if they just subtract it from whatever's left on the death benefit, and your beneficiaries still would get that tax-free death benefit, whatever's left on it. So it's a great way to not only take care of yourself if you need it, if you never use it, hopefully you never do, but it's there. And if you ever decide I want to cash it in, you simply cash it in and walk away. Great plans. And it's worked well for a lot of Christian Scientists so far.
Yeah, and what I like is the options are there. Anytime I do planning, I always look at it, what options are still available? And I have to deal with a lot of plans that have been put in place that didn't have options.
Right.
And it limits us. If you even think back to 2008 when the market crashed, real estate crashed, it was when people were scrambling to find money. And I saw some people that had to go in and cash out their policies. They didn't want to, but life had changed. Now they had to do something a little bit different. And there again, we make the best choices that we can at the time, knowing that our options are out there if things change in the future.
Right.
Now, one of the things that we look at, and this is some things I've been working on, is using life insurance instead of just the asset-based care policies. Mm-hmm. And the reason that we use the life insurance as an option, the underwriting criteria is different. So when you're looking at a long-term care policy, they're looking at morbidity or the cost of care. When we're looking at a life insurance policy, we're looking at mortality. How long are you going to live? And so there again, younger, healthier, and living a good lifestyle, your mortality is going to be better. And so it creates a different set of underwriting rules that can help us. It's also one where we have that cash value that we can grow inside the policy for what if. What else would we need? Maybe we wanted to, take some money and take the trip around the world. I don't know, but it's what if you need the money and want to do something different.
And Rick, I just want to interject here too. The nice thing about that cash, you can use it at, for example, Ardenwood. You can use the monies for whatever you want to stay home. There's no restrictions. There's no qualifications if you want to access that cash value. I'm not talking about on the rider. I'm simply talking about pulling out some of the cash, some of the equity in your policy. And that is awesome for Christian Scientists, because you don't have an insurance company telling you where you can receive your care. If you want to receive your care at Ardenwood, you can with these type policies, because you simply access the money and you pay cash as you go in. I love that for Christian Scientists. I think that's a great option for them, actually.
No, I think that's a great option. And we can also put the long-term care or chronic illness rider on that policy as well, yes, which there again gives us more of that long-term care feel. Right. But it also is one that it can create, it gives us the opportunity to check the box on multiple goals. Yep. Long-term care is covered. What if is covered. And we've got a death benefit, for our spouse or family, if, at the time we pass away. So there again, It creates options.
It does, yeah.
So if we look at it, we've got all of these different policies. And so I want to, take a little bit of a detour here and talk about some creative ways to pay the premium, because let's be honest, this is where the rubber hits the road, because we all like the benefit, and now we have to pay for it. so it's how do we reposition these assets that we have? The assets are income, and to get this other new benefit that could be something good for us. So let's look at, if we have a life insurance policy with a long-term care rider, there again, why would we use this strategy over a straight hybrid long-term care policy? We may have that need for the life insurance. That need may be to provide additional income to our spouse or to our family. I've also been dealing a lot lately with special needs trusts. So we have, special needs children that we need life insurance just to make sure there's money there for them. So whatever that need is, it's there. We may want or need long-term care. So there again, we've got some competing goals here that we're trying to check the box on both. But we also want to, leverage a gift if long-term care is not needed. There again, we don't want to have a use it or lose it. And so this is why we might get there. So if we look at, this, how we would reposition this, so we look at that asset mix that we've discussed, assets, income, whatever it is, we're going to pay the premium into a life insurance policy. Now, I want to make sure that this policy is set up so it has a death benefit. That's part of the life insurance policy. But we also want to build up a cash value bucket in there, create that what if bucket. Now, if a long-term care need arises, we can trigger that long-term care benefit, and that money will pay out of the policy, and it will pay out tax-free. So if that need arises, we've got that box checked. But I also look at it, what if during your life you want to, take a trip around the world? What if you do want to, have long-term care, but for whatever reason you don't want to trigger the rider? You can pull that out, go to Ardenwood, pay that cash, and all that money you took out of the policy was tax-free.
Right.
So it gives you the opportunity to reposition that cash midstream. Of course, then when you pass away, we've got a death benefit. That death benefit can go to family, charity, both. There again, how does it fit into your plan? And we make sure that we're putting that policy together so it meets your goals appropriately.
That's right. You know what I like about this, Rick, too? I'm visual. I like to, when I'm listening to something, I like to write it down. This shows really a great flow on the options you can use life insurance for, and you can take advantage of the insurance company. You can build equity in the policy and use it for what you want. And you know what's really the best thing about this? The IRS has approved this. The IRS is saying, you should go ahead and do this. Problem is, a lot of people don't understand that, right? That it's IRS approved. And I think a couple slides now, I think we've got the regs in there from the IRS showing why it's tax-free. So you just don't know about it, but it's a great tool for planning, I think.
And it's also one I have people ask, well, is this something that Congress is going to take away from us? And actually, last year, Congress improved what we can put into life insurance.
Why is
so
that,
it's
Rick?
not going away, it's getting better.
You think it's possibly because all of them have these type policies and they don't want to
could be a good reason.
Themselves?
We don't want to be that cynical, but you wouldn't be far off. Let's put it that way.
No, I'm being cynical because they all have them. That's why they don't touch it. So if they didn't have it, it was for us, it'd probably be gone. But
exactly,
that's the reality of it. If you look at the presidents, senators, Congress, they have these type policies. They understand how to leverage it, and that's exactly what they do. So
yep. So let's shift gears and let's start looking at how to reposition an IRA. And this there again, I look at this. I come across a lot of clients that have large IRAs. Mm-hmm. And they have these large IRAs, they build them up over their working years. And now it's time to access the IRA. They don't want to because it's taxable.
Right.
And it's one where there again, it's an asset that we want to look and see, can we reposition it in a way that makes sense? And so there again, if you don't need the income, if you're not living on that income, Now, if this is your lunch money, we don't want to touch it.
Right.
If this is something that you need, let's look at other ways to plan. But if you don't need it, it's a great way to reposition this asset, take care of your family with, if there's a life insurance need. Also, we get the long-term care covered.
Yeah,
And so
this is really, I'm sorry, Rick, I didn't mean to cut
go
you
ahead.
off there. But it's so important. I've talked to so many Christian Scientists. You're unbelievably blessed with good health. You also have wealth, right? You've accumulated, you're good savers. I've talked to so many that say, Jim, I have money in my IRA and my 401k. How do I use it for long-term care? Can I use that? So Rick's an excellent strategist, as well as he's got that tax background. So we had to create something visual, right, that would come out and show you how to actually use those monies for your benefit if you want to use them for long-term care. But you are incredible savers. Everybody I talk to nationwide, you've all got money. You're not quite sure. Like Rick said, some of you never want to really use the IRA. It's just there, and you're maybe thinking, gee, am I going to pass that to my children or grandchildren, or how do I do that? And it's what if money, right? The government's going to tell you you've got to take some out at a certain age. But still, I think this next slide, Rick does a great job, and I'm excited. So I just had to say that, Rick.
Thanks. So if you look at this now, the IRA is going to be different because of the tax situation. So if we look at this IRA, and these are just hypothetical numbers so that I can illustrate it. Let's say we have a $500,000 IRA. Well, let's do a trustee to trustee transfer of 200,000. There again, there's in most cases, and in probably all cases, we would never transfer all of it because we know it's there for two different purposes. So if we're transferring 200,000, we'll leave 300,000 in the IRA to continue that income that's coming out of there. The 200,000, we're going to put it into an IRA qualified single premium immediate annuity. That annuity allows us to go ahead now and pay premium over 5 years into the life insurance policy. And the reason we want to do it over 5 years is we're going to pay tax as we pull the money out of this IRA. So instead of paying the tax all up front, and which would drive us into a larger marginal tax rate, large tax bill, we'll spread that out over 5 years. Sometimes we'll spread it out of up to 10 years, whatever makes sense. And now we're going to put it into that life insurance policy. In this case, it's a $400,000 death benefit, which was double what we took out of the IRA. There again, this policy, we want it to build cash value. We want to make sure that this policy is designed right for you. So we've got a death benefit, we've got the cash value. And now that cash value, there again, the reason we have that cash value is the tax-free what if bucket. What do we want to use that for that we might want to use over time? So that money now is tax-free now that's coming through the life insurance policy. Whatever you need it for, it's available. And there again, it's creating that opportunity to check off more than one box. Right. There again, at death, where do you want the death benefit to go? Family, charity, combination of both. Whatever fits into your plan is what we want to have. And there again, the IRS with Congress and the tax code, all of this is buttoned up inside the tax code. We've got to make sure we can, do it the right way, but it gives you the chance now to reposition that asset in the right manner and create a tax-free benefit when you need it.
Right. And you're really helping, not only you're leveraging your money, right, and you're creating a more tax-free death benefit. Even if you have a couple adult children, I mean, I'm sure they would rather get 400,000 than 200,000. And when that 400,000 is income tax-free, it makes sense. It's better for everybody. The nice thing though is a lot of the Christian Scientists want to make sure that they're helping their charities. And this allows you to take that same asset, that 200,000, and multiply it, right? And not only take care of your family, but also take care of other charities. So I think it's a fantastic idea. I think it works really well. It's not for everyone, but I really think it's a great concept when taking taxable money, paying some of the tax now, because Rick, I'm thinking taxes aren't going to get any better in the next few years, right?
Now, if you open up the paper this morning, I say paper, nobody reads the paper anymore. So open up the internet. You'll see that Congress just released their new potential tax rates, what they're putting in the next tax bill. And so rates are going up, taxes are going up. So it just puts us in a position to reposition these assets so that we're creating leverage in the right places.
Okay.
And so if we finally look at, repositioning assets, there again, can we take what you have and create a bigger bucket? There again, if we have assets that we don't need, or assets that are just not performing as well as they should, can we do something better and also position them in a way that we can help pay potentially estate tax or income tax and create that long-term care bucket and life insurance benefit for the family?
Mm-hmm.
So if you start looking at repositioning the assets, we can go through the exact same way and take that savings account, that CD investment account, go through the single premium immediate annuity, or you'll see I've added a premium deposit account. So if we want to spread those payments out over time, we can drop it in there. It's an interest-bearing account so that they're putting the money into the premium of the policy over 5 years versus it all going in at one time. So we just always look at what's best. Putting the money in now, putting it in over time, there again, creating the best benefit for you is what we're after. Once we get that policy put in place, there again, create that long-term care or that what if bucket. There again, what I like about this bucket is it's there for you. It's not there for somewhere, after you've passed away. Most of the time when we talk, people hear life insurance. They always hear life insurance and think, well, that's a benefit to somebody after I pass away. What we want you to understand is this is a benefit for you while you're alive. This is a benefit for you and your spouse while you're alive. So it's one of those where we're creating a tax-free bucket of money that's usable now, but if you don't use it, it passes on to the family. So it creates that opportunity to there again, check off multiple boxes at one time. And we've repositioned the asset from what it is now, leveraged it into something better. So now now that we've gone theoretical, let's now look at some case studies. So these are case studies. Some of these are actual cases that we've worked on over time. So using real numbers so you can see how it all comes together. So let's look at an annuity that is focused on long-term care. And now, I know a lot of people, when they hear the word annuity, they don't want to talk anymore. Annuity, some people just say annuities are bad. Annuities are just a tool. Life insurance is a tool. When I do trust planning, it's a tool. We're just figuring out which tools are best, but these are long-term care focused annuities. And the reason we want to look at these, can we leverage your money or assets through this annuity? And the beauty of this, you can double or triple what you put in there for long-term care. You get tax-free long-term care benefits. The growth of the policy over time is going to be tax deferred. You get a death benefit. Now, here's the big one. There's no waiting period if you need to have care. So you remember me just mentioning not too long ago, my dad had an annuity. The annuity he was never going to use because it was taxable. We were able to take that annuity and with what's called a tax-free exchange you can do it with annuities and life insurance. We did a tax-free exchange of that annuity into a long-term care annuity. And so we were able to triple the benefit of that annuity for long-term care. And what would have been taxable under his plan was now tax-free.
Right. That's
let's
awesome. And
look
again, the IRS is telling you, go ahead and do it. Here's the regulations. We just want to make sure people understand that you can do that. So many scientists I've talked to, you have annuities that you've taken out and they're sitting there. So look at seeing how we can take advantage of them and turn something that's a taxable gain into an annuity that you can use for long-term care, where everything becomes tax-free when you use it for long-term care. So
yeah, and this is one where, you know, if you go back to the why, and this goes back to my legal background. We all, as an attorney, you learn in law school to dig back into the why. Why are these tax laws set up this way? And the real reason is, if you look at it, Congress wants us to have the ability to pay for our care.
Right.
If we aren't paying for our care, we become a burden on society. We
Right.
become a burden on charities. We become a burden on our family. And so it really is a way for us to put our assets to better use. But Congress's intent is don't become a burden. Now,
that's right.
let's be honest. Most of us, if you're on this call, you don't want to be a burden on your family either. You've done well in your planning. Now it's take that next step, and can you leverage it to do a little bit better?
Right. And Rick, just to take that one step further, I don't want to get too sidetracked here, but look what the state of Washington just mandated. They mandated that you must have long-term care. You're either going to buy it through them, you have to show proof that you have some type of long-term care policy. So just think about what's happened in Washington, and Oregon and California are looking at that right now. They don't want you, they don't want you to be dependent on government. So they're putting a buffer and they're requiring you to take this out. And the policies that they're purchasing that you have to get through the state of Washington, let me tell you, Rick, you've seen them. They're horrible. I would never sell that policy to anyone ever. But that's them telling you that you must either have that or show proof that you've got some type of policy. So just speaking to that point, that's what's coming down the pipe here. If Washington's doing it, it's going to go right down, I think, the West Coast, quite honestly.
Yeah.
So I didn't mean to take away from that, but that's something we were dealing with a lot of residents up in the state of Washington. So.
No, and it's one there again, it's, if we're doing proper planning, we can get around that.
Right.
And so here again, on this one, we're looking at a female age 74, putting in 100,000 of premium. So here's taking this from the actual contract. So if you would look at it there again, let's look at it if you don't need care. If you look at that contract value where the arrow is pointing, that's if you don't need care and you pass away, the family gets the money back. Now, if you want to pull the money out and just walk away, for the first 10 years, there's a penalty. But after 10 years, you can get your money back, no penalty. But that's there again, that's not why we bought this policy. We're buying this policy for the care. And day one, we have 300,000 of total long-term care benefit that can be used wherever you want it. Now they're going to pay that out at $4,167 per month for 72 months, 6 years.
Right.
So we've stretched your $100,000 to $300,000.
Right.
And so, well, go ahead.
This is a real life example. This is actually a Christian Scientist that we helped. And the point being, there's all kinds of annuities, right? There's hundreds of them out there, but this one is geared specifically for long-term care. And most non-Christian scientists can't get this policy because you have to answer health questions. This is all based on your health. And most scientists I've talked to, you are healthy enough to get this. If For example, if I answer a few of the health questions and I can't get them all, answer them all no, I can only qualify to double it. Well, if I can turn 100 into 200,000, that's pretty good. But every Christian Scientist I've talked to so far on these policies, you've all been able to triple it because of your incredibly blessed health. It's amazing. So that's you talk about leverage, Rick. Where else can you turn 100 into $300,000 for long-term care? Right? Simple and easy. You can use monies you have. You can use old annuity policies that you've had for years. So this is a great example of a real life policy that we've actually used in the last month. So,
and the other part of this is all contractually guaranteed.
right. Yep.
So it's not one where they can, 2 years from now change the benefit.
Right.
If you've
Can't
got
ask
it,
for more money. It's just set in stone. You're exactly right.
yeah. So
Yep.
great, creates a great opportunity.
Really does.
Now let's look at this one. And I brought this one in just so we're talking about if life insurance with a balanced focus. So there again, sometimes we don't have the ability to do multiple policies to check all the boxes and one at a time. So if we're looking at this, we want to leverage our money. We want to, there again, this is set up just to show one premium payment. The policy has a lot of guarantees in it.
Mhm.
We can use it for long-term care, but the big goal here is we don't know, we want to make sure we have a death benefit to cover the family needs,
Mhm.
but we also have the long-term care and cash value if we need to have the what if or long-term care issues. So looking at this, we have a male age 60. There again, 100,000 a premium. The goal is cash value and death benefit and long-term care. So really a balance of all three. If you look at this, the cash value is the amount of money. If you want to just start pulling it out, think about your savings account at the bank. If you go down to the bank and want to pull money out of your savings account, what is it? As you see, for the first 3 years, it's a little bit less than what you put in. After that, it grows. So if you let it grow until you're out into age 80, you're almost double on the cash value that you can take out of there.
Mhm.
But it's also one, if you pass away in the first year, you've doubled the money that the family's going to receive.
Right.
So we're there again. We've checked the box of having that what if bucket. What if we die and I need to, want to take care of the family? Now let's look at it and say, what happens if we need long-term care? And this one's a little interesting. If, it shows periodic payments, they can advance that. You can advance that 1 to 10 years, however you want to pay it out.
Mhm.
Or you can take one max lump sum. And as you see, those benefits grow every year. There again, what I like here is you're going to use it how you want to use it.
That's right, Rick. Yeah.
And there's
That's so-
always going to be a death benefit left for the family.
Yeah. The beautiful thing about this particular policy is, like you said, you can pull a lump sum out, right, and use it for care wherever you want. If you want to help your grandchildren, if you want to have your neighbor cut your lawn, if you want to have somebody shop for you, you can use those monies however you want. There's no restriction, right? And you can pull it out and it's there for you to use, whether it's Ardenwood or another, Chestnut Hill, wherever you want to go, you can use the monies for whatever you want to do. I love this policy too, right? You really leverage your dollars right away.
And that's the key. Leverage, but it's one I go back to what we talked about early on and think back to Jim's questionnaire that he sends out, and I send out one very similar. We want to know you. We want to get to know you and what you're trying to accomplish so that we can bring the right options, from the very start. Everybody asks me, what's the best plan? I can pull you out and pull out mine and show it to you. It's the best plan if you ask me. Now, if you're just like me, that's maybe the best plan, but it probably isn't the best plan for you. We want to make sure it's doing what you need it to do.
Mhm.
Finally, here, let's look at this one. Now, this is life insurance with the long-term care focus. So there again, it's built off life insurance, but it's one where we're really focused on the long-term care. Another way to, cover that care cost that may fit a little bit better. And so male age 69, I use the same $100,000 single premium just to keep it consistent. The goal was an increasing long-term care benefit. Now, the reason we looked at this is an individual that is in excellent health and probably will have a long life expectancy and will be quite some time until he needs to access that long-term care benefit. Has a lot of longevity, healthy longevity in his family. So we looked at this and said, okay, let's change this policy a little bit. So when we change this policy, we're looking at if he doesn't need the life insurance and needs to just walk away, that surrender value or cash value is if he needs to reach in and just pull some money out, that what if bucket. You'll see this one doesn't grow much. And the reason it doesn't grow much, we shifted to a different kind of policy that was not focused on that. There again, the death benefit is a little bit more than he put in, but never less than what he puts in. But now when I look at what the benefit is, day one, it's almost triple what he put in. But remember, I said there's a lot of healthy longevity in his family. So look what happens when he hits out here at about age 80, where he might need the care. Now it's 5 times what he put in. So there again, it's looking at you and your goals and your objectives and what you want to have happen.
Right.
Remember, this plan is for you and your family. And that's why we go out and create these options so that we can make sure we get the best options in front of you.
We're going to do a few Q&A, John. Do we have a couple today?
Great. Jim and Rick, thank you. This is just great. Yeah, I've got some good questions here. And why don't we just go right to those? The first one is, what is the meaning of a death benefit? Is it just to pay for a funeral?
It really is, the death benefit there again, it's when you pass away, there's going to be the benefit from the policy paid out. It really comes down to what do you need the money for? Funeral, liquidity. A lot of people, there again, most people, when somebody passes away, there might be an outstanding mortgage on the home. There might be a need for income for the surviving spouse or the kids. It really is, when I'm looking at life insurance from the death benefit standpoint, I'm always looking, from it backwards. What are we trying to create a bucket of money for? So it's one of those, it could just be, it could just be for funeral expenses. It could be, for larger estates, it might be to help with paying the estate taxes. Might be helping to pay the income taxes that the kids will pay on your retirement accounts that they inherit. Whatever it is, we want to make sure that we understand what it's being used for. Because I also get the question of how much insurance should I buy?
Right. As much as you can afford.
Yeah. It really comes down to what's it being used for? What can you afford? Because I want you to look at the life insurance, just like the long-term care. I want you to look at this as an asset, not an expense. This is providing a benefit. And if you understand why, the mentality shifts from expense to asset.
Right. And I got to say this, in the last month here, I've had 3 death claims come through from existing clients for a long time. And it's kind of interesting, from doing this for 33 years. I've never had anyone ever tell me, gee, that check's too big from the insurance company. Normally it's like, quite honestly, is that all he got? I go, well, that's all he wanted, right? So I've never had anyone tell me that's too much, because if you get too much, then you know what to do with it. You've got charities, you've got family members that you can go help people with. So it's horrible to have to deliver death benefits, but that's what the money is there for. And again, your children are happy to take more, I guarantee it. And charities they're hurting right now, and anything you can do to help charities right now is a real good thing. And if you can leverage that through life insurance, then go get some more, as long as you're healthy enough and you can afford it.
That's great. Next up, is there an age below or above which it doesn't make sense to set up the SPIA?
No, there really isn't. It isn't age specific. It is one that we're looking at. Let's take a step back to qualifying for the life insurance or the long-term care. It's there again. We're looking at that part first. And the single premium immediate annuity is just helping us, to move that money over more tax efficient.
Right.
So that's just, think of that just as a conduit.
Right.
It's there to help solve the problem. The bigger issue is, what's the cost of the life insurance and the long-term care? If that one makes sense, then the single premium immediate annuity will make sense.
Right.
Great. Here's a good one I think that a lot of people think about, especially Christian Scientists. How do you prove how healthy you are?
They don't completely take your word for it.
Yeah.
Okay. So it's one where in the underwriting process, it starts off by the application. The application is, really, let's start out with the basic information: who you are, what type of policy do you want, who would your beneficiaries be. Then they're going to go through a health questionnaire. That health questionnaire is going to be very detailed. Do you have issues with any of the following? Mm-hmm. Now, if you're younger, and by younger, under age 60 now, that may be enough. That they can, they'll look at that. They'll look at your potentially, a couple of national databases, and they can issue the policy.
Right.
If you're over age 60, then they're probably going to ask that there be a paramed exam, which is blood and urine. And then they're just going to make sure that you qualify for the policy that you're after.
Right.
Now, this is where we also shift over to the annuities. And one of the reasons we like that annuity that we illustrated is the benefit really comes off of 11 questions. If you can answer no to 11 questions, they'll issue the annuity.
That's right.
So,
and I haven't had a Christian Scientist answer yes to one yet. So quite honestly, it's pretty amazing. But I agree with Rick too, especially the nationwide product we've used. It's simply a phone call. They talk to you over the phone. They ask you the health questions. They want to check and make sure that you're still capable of making decisions, that you don't have any type of dementia too. So a lot of the companies will now just allow us to take the information on an application, do a simple phone call, and they confirm with you just to make sure you're okay. Sometimes the ones we've been using right now, we don't need a paramed exam. But like I told you before, Rick's looking at companies for us. Every day we're trying to find other companies. Some of them will give you the policies, but they do require that you show proof of good health, right? They don't understand Christian Scientists, quite honestly. Even though we explain it to them, right, John, 100 times, they just don't. But there's certain companies, and there's another one we're working with right now that I think we're going to have some good news on in a couple of weeks. So where again, they're just going to simply call and you can do the phone interview like that and see if you qualify. At an older age too. We're looking at older ages. If the one today, Rick, that we're looking at, it goes up to actually age 85. So we're working with them right now too to see if they'll be Christian Science friendly.
Excellent. That's great news. Thank you for doing all that. Next up, What does periodic payment advance in life insurance example mean?
It means that you can advance that over more than a year. So it's one where when on that particular policy, you can decide how you want to spread those payments out from 1 month to 10 years. So it really comes into what I like about that is you're deciding how you need to use the money, not them telling you how you're going to use the money, or how often they will pay you. And there again, we want flexibility in the payments. There again, it's one sometimes. So I look at my wife's stepdad that just passed away not too long ago. It looked like he was going to pass away last December. I mean, it was to the point everybody was planning on getting to town because it was imminent. Well, roll forward about 30 days, and all of a sudden he recovered. So what's nice there, if you look at having the control over those that money, if you need the care you've got the money. If you need just a little bit of the care, you can adjust it down. If you need more, you can adjust it up to fit the need that you have.
Boy, just the benefits of planning are just endless, aren't they? How can we address the issue of inflation, incorporating like an inflation rider and inflation into someone's plan? Because we're hearing more and more about inflation these days.
So depending on the policies, depending on what product that we can use, some of those have inflation riders, 3% up to 5%.
Right.
And so we can build that in. If we think we need more than that, then we can start the base a little bit higher than that. Yeah. So it really is, there again, the younger you are, the more options there are available.
Right.
And there again, as you get older, some of the options go away. It doesn't mean we've lost all of the options. We just want to make sure that we're getting in as soon as we can and building in that inflation rider. Now, sometimes the inflation rider is counterintuitive as well. And what I mean by that is, let's say, take that example I did of the 69-year-old male. And there again, we're looking at it saying, okay, we need that, 5 times multiple at age 80. Well, we can also look at that and we can start with a bigger base and not have an inflation rider.
Right.
So we've got let's say it's a 3 to 4 times multiple day one with no inflation rider. So it really comes back to, we want to look at it and see what's the best design.
Right.
And usually, and Jim does the same thing that I would do. We'll show you both,
right,
and give you the option to see which one fits the best. But it really is. There again, healthcare is going up. The cost of care is going to increase, and so we want to be realistic and make sure if we don't think we're going to need the care for 10 years. Let's look out there and forecast what that is. And Jim's got a website that he can use that will forecast that care, 10, 20 years out.
Right.
Now I can tell you the numbers, and Jim and I have talked about this, the numbers can get scary.
Right.
Because when you're forecasting that out at today's inflation rates, it can be a scary number. But there again, we also want to be realistic with what the need would be.
Right. But I agree with Rick. Sometimes it's better to start with a lower benefit and allow it to grow over time, especially if you're younger. If you're 60, 65, you put that 5% inflation on the policy, and normally rule of thumb, 5% compound doubles in about 14 and a half years. So you start off lower because you probably don't need that benefit. But boy, when you're in your 80s, if it's doubled, that means a great deal, not only to you, but to your family. So you've got more money to take care of you so that you don't have to go to a nursing home, so that you can stay home and have more options. That's the whole idea. You decide how you want to spend your money and take care of your family. Can take care of you. They supervise care, Rick, right? They don't provide care. That's the advantage of doing planning.
Well, this has been a great session. That's all the questions we have today. Thank you, Rick and Jim, for explaining life insurance alternatives to long-term care options so clearly. This has been great. Just good questions, great presentation. And thank you all once again for joining us today. We look forward to seeing you this Thursday afternoon for more Q&A. Same time, same Zoom link. You will receive a reminder. And we hope to see you next month to address another aspect of legacy planning, charitable remainder trusts, or CRTs. I think that's going to be a really popular one. So it'll be on Tuesday, October 19th, with the Q&A on that Thursday, October 21st. So thanks everyone once again, and goodbye for now.
Thanks, everybody.